Welcome back. You're watching Midcap Radar on CNBC-TV18. It's time to focus on Nelco. The stock is lower in trade on the back of its fourth quarter numbers. Revenues and EBITDA margin contracted on a YOY basis. To discuss this and the opportunities going ahead, what is the business outlook? We are joined by Mr. PJ Nath, the MD and CEO of the company now. Mr. Nath, good afternoon. Thank you so much for joining us. Quarter four has been slower than your earlier quarters. The growth in terms of revenues is not there, actually. It's down 2% sequentially, down 0.5% on a YOY basis. What led to that? Is there any particular reason here?
Yeah, so while you look at a quarter, I think we would like to talk more on a year basis because the quarters are not exactly the representation of how the business goes. It depends on some of the larger projects getting implemented in that quarter, etc. So therefore, if you look at from a year perspective, our revenue has grown by about 2%. But what is important is that our profits have grown by 20%. And overall, the company has become much healthier. Our operational efficiency has gone up. Our ROC has gone up to 29%. The balance is much more healthier. Debt equity ratio has gone down to 0.28. So overall, I think as a company, we have done well. The revenue has not grown the way we expected because of some of the newer projects which are supposed to have come have got delayed due to certain market factors, which will come in this year. So we are not overtly worried about the top line not having grown the way we wanted, because the rest of the parameters of the company have been very healthy.
Mr. Nath, you've mentioned that you've not seen revenue growth to the extent that you wanted. Internally for FY24, what was it that you're working for? At the end of the year, you have a revenue growth of close to 2.2%. You alluded to a fact that few of the deals didn't really start off. Would you have a sense? Could you give us a sense of which of the deals that didn't kick off? And FY25, can we see resumption of some of these deals?
Yeah, so I don't know. We don't specifically talk of deals. To that extent, I'll not want to talk of specifically the deals. But yes, to answer your questions, yes, the revenue in FY25 would be significantly better than FY24. Although we don't give any guidance, and therefore I will not talk of any specific number, but it will be definitely better than that. As I said, it happened because of certain large projects not coming at a time that we were expecting, but they are on track, and that will happen in this year.
Okay, so you cannot give us a quantitative number. Your FY23 growth was 20% in terms of revenues. Your FY22 growth was 15%. Do you think you'll be able to do that number?
As I said, I don't give specific numbers, but yes, we are very bullish on FY25, and FY25 will be significantly better than what we had FY24.
Even in terms of margins, Mr. Nath?
Yeah, margins, our EBITDA margins have remained at about 90 to 20%. That has remained. Our profit margins have gone up. Our profit growth is much healthier. Our debts have come down significantly. Our debt equity is 0.28 against 0.43 last year. And so these are very important parameters that we consider. ROC, as I said already, it's about 29%. So overall, the company has become much healthier. We have invested in more capacities. So we've grown the capacity by more than 23%, but that happened towards the end of the year. And we are still in the process of increasing capacity, and all of that will start paying off in FY25. So therefore, we are fairly bullish. The company is healthy, and we are able to make investments. And I think that's what we are looking for. We are in the long-term game. And from a long-term perspective, I think we are in a pretty good state right now.
Right. Mr. Nath, now a couple of questions. First up, could you give us the debt figure for us as well, how much it has come down by? And the second question is, for FY25 and FY26, where is the revenue funnel that you're seeing from? Is it coming from in-flight services, maritime connectivity, or is it coming from the satellite policy? Where do you see, or how do you see the revenue mix panning out?
See, we are, let me answer the revenue mix part first. We are operating in enterprise, aero IFC, and maritime. And we see the growth in all of them. In fact, for FY24, our IFMC, that is aero IFC and maritime, grew by 20% over the previous year. So that has gone fairly healthy. For FY25 and FY26, we see growth there as well as in the enterprise sector. You talked of the new space policy. The new space policy is making the market far more open. It is deregulating, and therefore, that, to my mind, will give boost to the market. It is becoming easier to do business, but a full impact would not be seen in FY25. To my mind, that will go till FY26. But overall, the policy framework has improved. The telecom bill has also come with a clear guideline that the spectrum for satellite would be administratively allocated, though we need to see exactly what the modalities of that would be. So therefore, all the regulatory parameters are all healthy. They are progressive. And so therefore, we believe that, and also the newer technologies coming, newer satellites coming, the cost of satellite capacity coming down, with that, we will be able to, we see the market moving much better than what has happened so far. Our current debt is around 20 crores, and that's what we have got right now.
And will you be able to see, will you see an increase in your debt because of the capex or the capacities that are coming by?
No, in spite of the increase in capacity, it is still 20 crores. But next year, yes, we've got large plan for making investments in Capex this year. So therefore, we'll have to look at how the debt will go up or remain the same. But we are making investments in Capex this year because we believe that there will be a lot more investment that will be required to address the growing needs of the market.
Thank you so much for your time, Mr. Nath. We wish you all the best for FY25. Now, as we slip into a short break, here's a programming note for our viewers. Our Friday special offering, Editors Roundtable, is now coming at a new time. Catch the biggest market headlines of the week with expert analysts from market veterans and our own editors every Friday now at 3:30 p.m. Don't forget to tune in.